Economist of the MB Fund and MB Super, Leith Van Onselen, he raised three alternative approaches that could be considered instead of the government's Div 296 proposal to tax unrealised capital gains on super balances over 3 million. First, lowering the threshold and tax realised gains only. They could reduce the super balance threshold to 2 million, index it to wage growth and apply a 30% tax solely on realised earnings. And this method could actually target income rather than hypothetical gains. Now, a second option, and it's likely very unpopular with retirees, would be to tax earnings in the retirement phase. So currently from 1st July 2025, a retiree can have up to $2 million in their super and pay no tax on their earnings, whilst workers are being taxed at full marginal rates. Now, applying a standard 15% tax on realised earnings during the retirement phase, that could promote equity and also contribute to federal revenue. Thirdly, another option could be replace the flat tax on super contributions, concessional contributions, with a flat deduction. So instead of the 15% tax on concessional super contributions, implement a 15% tax deduction from the individual's marginal tax rate. Now, this change, it could make super concessions more progressive and benefit lower income earners, reducing the cost of concessions. So for example, an income earner on the highest marginal tax rate of 47%, less a 15% deduction, will pay super contributions tax of 32%. Whilst a low income earner, say on the 18% marginal tax rate, less a 15% deduction, will pay only 3% super contributions tax. These alternatives could offer more practical solutions to reforming super taxation, avoid complexities and potential inequities with taxing unrealised gains. I'm always keen to hear your thoughts on this subject, and please do so in the comments section.